Consolidation of a wholly owned subsidiary with no differential. The net assets are purchased at book value. You have in front of you the same information. It shows the parent acquiring 100% of the sub for $450,000 cash. We can look at this and see, before we go, you should be able to figure this out now. The fair value is going to be the assets, $750, minus the payables, minus the bonds payable of $300,000. So we get a fair value of $450. The same on the book value. Let's go ahead and record the initial investment. We're going to debit investment, credit cash. You see that the initial recording of the investment under the cost method, the equity method, and the consolidation method are the same. Debit the investment, credit cash, or however we pay for the investment. We need to compute the differential. We already know that it's 0 for this example, but we need to go ahead and practice, and as we build, we're going to have a differential, so let's see what we do. The purchase price is $450. The NCI value in this case is 0. The fair value of the net assets is $450. We just saw that. That gives it 0 goodwill. The book value of the net assets is $450, and that gives it 0 excess fair value over book value, and gives us a total differential of 0. We're going to use this building block illustration here to kind of break down fair value and see what we do with the excesses and with the book value as well. The way this reads is the fair value consideration is at the top. The goodwill amount is listed in the green box. The excess fair value is listed in the purple, and it's 0. The total fair value is listed to the left at $450, and then the book value of the net assets is listed as $450. That's our starting block. So the blue will be our base foundation, and we're going to see with our consolidation accounting, the book value becomes our foundation, and we handle the green and the purple separately. We refer to these two as excess values, and then obviously the blue is the book value. What we're going to do is, in this process, we're going to do a book value computation, and then we'll do an excess value computation later in Chapter 4, but our starting point is the book value. This book value computation is going to help us with our EJEs when we do those a little later. Here's what we have now. We know that assets minus liabilities equals equity, or net assets equal equity. So for $450,000, we purchased the equity of the subsidiary. The common stock was $300, retained earnings was $150, and that gives us our total investment of $450. This is going to come to play when we do our EJE. At this point, we have debited the investment for $450, credited cash for $450. We see that the investment sub has a balance of $450, and we see also that the sub we have there. Now notice one particular difference here. In Chapter 1, when we listed the subs amounts, we listed their fair values. When we consolidate, we're going to list the subs book values. Remember, I've said that the consolidation process is kind of in the middle between the parent and the sub. We don't go back and restate the subs records of fair value. We're going to increase them to their fair value through the consolidation process. We'll do that again in Chapter 4, but just for now, remember, the sub, we will list their assets and liabilities at book value. Now, just from our lecture on Chapter 1, we know that when we consolidate, that we have to do something with this investment sub of $450. If we brought it over in the consolidation process, along with the sub's assets, we would be double counting the 450 or the net assets of the sub would be included in the consolidated amounts as well as the investment. Here's what we're going to do. We're going to have EJE1, and we're going to eliminate the subsidiary's equity. This is what we're going to do. We will always go through this process when we do our EJEs. In every instance, we will eliminate the subsidiary's equity. That equity is going to consist of common stock, any additional paid in capital, and retained earnings. In this instance, we have common stock of 300, retained earnings of 150, and then we're going to debit those and then credit the investment sub for 450. Look at your book value computation. Those numbers from the book value computation play a role with this EJE. We made the EJE. Let's go ahead and post that EJE to our consolidated worksheet. Notice what we do. We extend everything over. All the numbers are there. The only difference is the investment sub is gone and the subsidiary's equity is gone. One thing to point out is if you notice in the middle column, you'll see the number 1. If we go back one slide, 2 slides, we see that this number 1 is our EJE number 1. We reference that on our consolidated worksheet, our 3-part worksheet, so that we know where did that $450,000 in the credit come from. It came from EJE1. This is referred to as cross-referencing. Once we're done, we see the investment sub is 0, and then we can see that the equity account has eliminated the sub's equity. Whenever you do your consolidation accounting, if the investment sub account is not 0 in the consolidated column, you have done something wrong. The investment sub will always be 0 in the consolidated column.